So welcome back. Hopefully you've got your notes. You've still got your page of T accounts. We're going to pick right up where we left off at the end of Objective 2, and we're going to continue recording those costs in our job order cost system. So we've already recorded the materials that we used, both direct and indirect. Remember, direct went directly into work in process, indirect went through overhead. We've recorded the labor that we used. Direct labor went directly into work in process, indirect labor went through overhead. Now we've got lots of other bills that we're going to pay with respect to the factory. And we know that everything, all the costs that we incur in our factory, if they're not direct materials or direct labor, they go through overhead. So here we've got a list of some costs that we had. We've got the depreciation on the manufacturing plant and equipment. We've got the plant utilities. We've got the plant insurance. We've got the plant property taxes that we have incurred but not yet paid of $5,000. So since all of these have to do with the factory or the manufacturing facility or the plant, all those words we used interchangeably, we know that these are all product cost. Since they're not direct materials or direct labor, these have to go through overhead. So all of these costs are going to be put into the overhead account. So let's look at this. So the first one that we saw was depreciation. Now we learned back in financial accounting that when we record depreciation, we debit depreciation expense and we credit accumulated depreciation. Remember, accumulated depreciation is a contra asset. It's going to show up on our balance sheet as a reduction. So we'll show the plant and the factory equipment at its historical cost, and then we subtract the accumulated depreciation right underneath it to give us net book value. So normally we would debit depreciation expense, but since this is a product cost now, we're not going to debit depreciation expense, we're going to debit an asset, and that asset would be overhead. So now I'm going to debit overhead, credit accumulated depreciation for $20,000. So these are just like the journal entries that we learned in financial accounting, except the debit has to change to be an asset now. So next we had the utilities, I believe it was. So we debit overhead instead of utilities expense and we credit cash. Next we had our insurance, so we're going to debit overhead and credit prepaid insurance. Remember, we learned originally that we debit insurance expense, credit prepaid insurance when the insurance expires. Now we're going to debit overhead. The last one was the property taxes. Now normally we would debit property tax expense, credit property taxes payable. But since this is property taxes on the factory, we can't debit an expense, we have to debit an asset. So we're going to debit overhead and credit property taxes payable. So now we've got 4 debits to our overhead accounts. As you post those to your overhead T account, you'll have 4 different debits that go into that. So if we look at our overhead T account now, we see that we have the $17,000 was for the indirect materials, the $28,000 was for the indirect labor, the $20,000 for depreciation, the $7,000 for utilities, the $6,000 for insurance, and the $5,000 for property taxes. In financial accounting, in a merchandise company, we would have debited an expense for each one of these, but not now. These are product costs, so we're going to debit the overhead account. So one thing I want to point out is if you look at the overhead T account, notice that the debit side of the overhead T account is the side that has all of the actual cost. These are the real overhead costs. $17,000 is actually how much we paid for indirect materials. $28,000 is actually how much we paid for indirect labor. $20,000 is actually how much we recorded for depreciation. $7,000 is actually the total of the electric bill. So these are all of our actual cost on the debit side. Now, these costs, that 83,000 that we looked at there, those were all of the actual cost, but they were for all of the jobs that we were working on. We looked at earlier, we had 3 jobs that we were already working on, job 27, 28, 29. We started some new jobs in here. So The problem is that we know the actual costs are 83,000. We just don't know how much of that should be applied or allocated to each of the jobs. So the way that we do that is we use what's called a predetermined overhead rate. Now, one of the things I want to point out here is the prefix pre. So we have this thing called a predetermined overhead rate, and the prefix pre means before. So this overhead rate was determined before the year began. In fact, we're going to see when we get to our budgeting chapter later on that we actually calculated this overhead rate last year when we did the budget. Okay, so back in this world, it's 2026. We did this, calculated this rate probably in July or August of 2025. So notice that it is based off of estimates because last year when we did the budget, we didn't know what the real amount was. We didn't know that 83,000 was the actual overhead amount. So our numerator is the total estimated, or you could say budgeted, overhead costs for the entire year. And then we've divided it by the total estimated, or again, you could say budgeted, overhead of what we call an allocation base. You'll also hear this called a cost driver. So the allocation base or the cost driver is whatever we decide is the best way to allocate overhead. So we're going to look at the overhead and we're going to figure out what is the thing that causes this overhead to be incurred. What is it that causes a job to use overhead? And that's how we're going to allocate it. So the three most common cost drivers or allocation bases are direct labor hours, direct labor cost, and machine hours. So let's start with machine hours. That one's a little easier to understand. So if we're running a factory and we're making a product that is highly automated, okay? It uses a lot of machine hours. It takes a lot of machinery, things like that. Then we probably have a very high electric bill. Our electric bill is probably a very large portion of our overhead. So we might say, well, hey, the best way to allocate overhead between these jobs is how many machine hours, with the idea being that if a job uses more machine hours, they're using more overhead. So we'll allocate it based on how much machine hours they used. If it's a more labor-intensive process, meaning it requires more man hours, more hands-on hours, if you will, then we might say direct labor hours is the best way to allocate this overhead, meaning the longer it takes our employees to work on this job, the more of the overhead costs they're using up, so the more overhead we should allocate to their job. Now, if it takes specialized labor, then we might decide that direct labor cost is the best way to do it. So the idea behind this one is that you may have employees that are working and you're paying them different rates. And so you'll give the most complicated jobs to the most experienced workers, and then you'll give the easiest jobs to the newbie workers. The most experienced workers make more per hour, therefore it costs more to assign them to this job. They should have the higher overhead. So I always think about if we're a tax company. And so you have two different tax accountants. You have one person who's been doing taxes for 40 years. They know the tax code inside and out. They know everything about it. And then you have a newbie who's just graduated from school, who's brand new. This is their first tax season. They really don't know how to do anything. They have to look everything up, right? When the customers bring their tax returns in, if you have somebody that has a really simple 1040, they just have W-2 income, nothing really complicated, you're going to give that tax return to the newbie. But if you have somebody who comes in and, I don't know, they own their own business and they have 3 or 4 rental properties and they have lots of investments and they itemize their expenses and it's a really complex tax return, you're going to give that to the more experienced tax person. So maybe both of those tax returns take 20 hours, but the newbie spent 3/4 of those 20 hours looking up the tax laws because they don't know them, and whereas the veteran spent those 20 hours working really, really hard. Right. So that veteran used more resources in their 20 hours. They should use more overhead. So in that case, we might allocate it on the basis of direct labor cost, not just direct labor hours. You won't have to decide what the cost driver is. You will always be told. I just want you to have an idea of be thinking about what you would choose here. Now, there's a million other cost drivers that you can use, and we'll talk about these more as we get to chapter 4. These are just kind of the 3 most common in a manufacturer. So we're told that Smart Touch Learning is going to allocate their overhead on the basis of direct labor cost. Okay. So on the basis of direct labor cost, in last year when they were doing the budget, they estimated that overhead for the entire year would be 68,000. So this 68,000 is our numerator here. And they estimated that they would use 170,000 of direct labor costs. So that's my denominator here. Okay. So when we divide that out, we'll get a rate of 0.4 or 40%. Now let me point something out. Since in this case we have dollars in the numerator and dollars in the denominator, it's customary to convert your rate to a percent. You could think about it like this. For every dollar of direct labor, we want to apply 40 cents of overhead. Okay. If our denominator had been hours, machine hours or labor hours, we would not convert it to a percent. We would just leave it as a dollar per hour. So I'm going to write on this and then I'm going to erase it. You don't write, you just look. So if this had said direct labor hours, and we erase the dollar sign here, then we would divide, and this is hours, then we would divide $68,000 by 170 hours. This would come out to be 40 cents per direct labor hour. We would leave it dollars per hour. But since both the numerator and the denominator were dollars, again, we're going to convert it to a percent. So we know that that estimate is wrong. Actual overhead's not $68,000. In fact, we know it's 83, but we know this in hindsight. And we know that direct labor dollars weren't actually $170,000. Doesn't matter. So we're told that for job 27, the direct labor cost was $1,250. We're going to apply overhead to this job on the basis of 40%. So we're going to multiply 40% by $1,250, and that gives us $500. So we're going to apply overhead of $500 to job 27. So here we're looking at job 27's job cost record. We're going to see that they used $2,750 in direct materials. They used $1,250 of direct labor, and they used $500 of overhead, or that's how much we're applying. So we can see their materials cost right here. We can see their labor time right here, and then we allocated the overhead by multiplying the actual amount of direct labor by the overhead rate to get the amount of overhead applied. So the total cost of job 27 was $4,500, and this $4,500 was for 15 tablets. So $4,500 divided by 15 tablets is how we get $300 per unit. That's how much it costs to make these for Central College Bookstore. This is not what we're selling them for. This is how much it cost us to make these. So transaction 8 tells us that direct labor cost for the entire year was $169,000. Now that should sound familiar. We did that journal entry earlier, or we were given that data earlier. So now we're going to apply overhead to all of the jobs on the basis of 40%. So first of all, we need to say 40% times 169 is 67,600. And then we're going to debit work in process and credit the overhead account. So again, the 67,600 came from the 169,000 multiplied by 40% or 0.40, and that's how we get 67,600. We're going to transfer this amount out of overhead. So we're going to credit the overhead T account, and we're going to debit the work in process T account to transfer it into work in process. So once you've written this journal entry and you've posted these to the T accounts, your T accounts should look like this. I'm going to erase this right here. So now in work in process, I see my beginning balance. Transaction 2 was my direct materials. Transaction 3 is my direct labor. And transaction 8 was the overhead. So all of my product costs are now accumulated in that work in process T account. Now the other thing that I want to point out is if we come back over here to this overhead T account, remember we said that the left side of the T account is the actual side. The right side of the T account is the amount that we allocated or applied. We use those words interchangeably. So in this case, we know that actual overhead, if we add these up, actual overhead was $83,000. But we only allocated 67,600. So actual overhead exceeded our estimate last year of what we estimated. We underestimated what overhead was going to be. So we wind up with a debit balance in overhead. And this is because overhead in this example is under allocated. We should have allocated 83,000. We only allocated 67,600.